Welcome back to WealthWise, the podcast where we make financial strategy crystal clear. Have you ever stopped to wonder why, despite working harder than ever, that feeling of financial anxiety just doesn't go away? You follow the traditional path, get the degree, land the good job, climb the ladder, but financial peace of mind still feels like a distant destination. Well, today, we're going to challenge that entire playbook. We're going to deconstruct the 3 fundamental money laws that for some reason were left out of our school curriculum. These are the principles that separate those who simply look rich from those who are truly building lasting freedom. And there is genuinely no one better to walk us through this than our guest today. He is a renowned financial strategist, an educator to thousands, and the brilliant mind behind the best-selling book, The Cash Flow Code. Please join me in welcoming the one and only Max Wise. Max, it is an absolute pleasure to have you on the show.
Sarah, the pleasure is all mine. I'm excited for this conversation.
I am too, because by the end of this episode, everyone listening is going to walk away with a completely new lens on their finances. Specifically, you're going to learn why your home, the one you think is your greatest asset, might actually be a financial trap, how to finally distinguish between good debt and bad debt so you can break free from the cycle of endless monthly payments. And perhaps, most counterintuitively, you'll discover when being cheap is the most expensive mistake you can possibly make. So Max, let's dive right in. The principles we're about to discuss feel so foundational, yet they seem to go directly against everything we're told by society. Buy the big house, drive the nice car, secure the corner office. Why is there such a profound misunderstanding about what it truly means to build wealth?
That's a brilliant question, Sarah, and it gets to the absolute heart of the problem. We live in a society that has become obsessed with looking wealthy rather than being wealthy. The two are fundamentally different, yet we're conditioned to believe they are the same thing. Robert Kiyosaki famously pointed out that most people spend their entire lives buying liabilities they've been convinced are assets. It's a beautifully simple yet devastatingly accurate observation. Think about it. The new car on a 5-year loan, the designer clothes on a credit card, even the primary home we live in. Every single month, these things act like a financial siphon, pulling money out of our pockets for loan payments, insurance, maintenance, and property taxes. Yet almost no money flows in. We're accumulating things that drain our financial energy, not build it.
A financial siphon. That's a powerful visual. It suggests we're actively working against ourselves without even realizing it.
Precisely. And it's a silent trap because it's wrapped in the language of success. Let me give you a real-world example. I had a client a few years ago, a top executive at a tech firm earning over $250,000 a year. By all external metrics, he was the definition of success. He had the beautiful house in the suburbs, 2 luxury cars in the driveway, and an Instagram feed filled with exotic vacations. He looked incredibly wealthy. But when we sat down and looked at his actual numbers, he was living paycheck to paycheck. In fact, he was one bad month, one unexpected emergency away from total financial disaster. His income was high, but his outgo was even higher. He was servicing the debt on his lifestyle. On the surface, he was the picture of success. But financially, he was on a treadmill, running faster and faster just to stay in the same place. He was trapped by the very things that were supposed to signify his freedom.
That's such a powerful and, frankly, terrifying image, Max. The idea of being house rich but cash poor is something I think a lot of our listeners can relate to. It feels like we're all playing a high-stakes game without ever being taught the rules. So let's start teaching them the rules. Let's get into the first and perhaps the most important of these money laws you mentioned, the one that completely redefines how we should view our money and our assets.
Max, that story about your client is a perfect, almost chilling illustration of the illusion of wealth. It sets the stage beautifully for us to dive into the actual mechanics of escaping that treadmill. So let's start with your first law, which I find so poetic. Cash is king, but cash flow is queen. It's a brilliant phrase. Can you break down what that means for someone who's always believed that a big pile of cash and a house with their name on it is the end goal?
Absolutely, Sarah. And it's the single most important distinction to grasp. It all boils down to two simple definitions. An asset is something that puts money into your pocket. A liability is something that takes money out of your pocket. That's it. The game is to acquire assets and avoid liabilities. Now, where everyone gets it wrong is in identifying which is which. Let's take the biggest sacred cow of personal finance, your primary home. We are all taught that our home is our greatest asset. But let's test it against our definition. Does the house you live in put money into your pocket every month? No. In fact, it does the exact opposite. Every month, money hemorrhages out of your bank account to pay the mortgage, the property taxes, the homeowner's insurance, the surprise repairs when the water heater breaks, the landscaping, the upgrades. It is a beautiful, expensive pet that you have to feed constantly. It relentlessly takes money out of your pocket.
But what about appreciation? People will immediately argue, but Max, my house has gone up in value by $200,000. Isn't that an asset?
That's the great illusion. It's what I call phantom wealth. Yes, the value on paper, the equity, has increased, but that money isn't in your bank account. You can't use it to buy groceries or pay for a vacation. In fact, what actually happens when your home's value goes up, your property taxes go up, your insurance costs go up. So your monthly expenses just got higher, but your monthly income hasn't changed. You feel richer, but you're actually more cash poor than before. The only way to access that $200,000 in equity is to sell the house, which means you no longer have a place to live. So you have to take that money and buy another, likely equally expensive house. It's not a cash-producing machine. Now, let's contrast that with a true asset. Imagine you buy a different house, a rental property. You put a tenant in there. The tenant's monthly rent check pays for the mortgage, it pays for the taxes, it pays for the insurance, and it pays for a property manager. And after all those expenses are covered, there's $400 left over that gets deposited directly into your bank account every single month. That is an asset. It puts money in your pocket. The same goes for dividend-paying stocks that deposit cash into your brokerage account every quarter, or an online business that generates sales while you sleep. This is the essence of cash is king, cash flow is queen. Your cash, the money you earn from your job, is the king. He's your powerful soldier. The average person sends their king out to buy liabilities, the fancy car, the expensive clothes, the big house. They send their soldier to die on the battlefield of consumption. But the wealthy send their king on a mission to find a queen. The queen is a cash-flowing asset. And once the king brings home the queen, they create an entire kingdom of passive income that funds your life forever. You can't show off your stock portfolio at a dinner party the way you can a new Rolex. But eventually, that portfolio will buy you the Rolex, the car, and the dinner party, all without you having to check the price tag.
That king and queen analogy is going to stick with me. It's a complete reframing of the purpose of money. And leads perfectly into your second law, which feels like the dark side of that same coin. Do not spend tomorrow's income today. This seems to be the default mode of operation for so many people, especially in their 20s and 30s, with buy now, pay later services and easy credit. Is this the trap that keeps people from ever being able to even think about buying assets?
It's not just a trap, Sarah. It's a form of modern-day indentured servitude. We just call it debt. Let's be brutally honest about what debt is. Debt is selling a piece of your future freedom for a temporary pleasure in the present. You are literally taking the income you haven't even earned yet from next year, the year after, sometimes the next 30 years, and pulling it into today. And for that privilege, you have to pay a fee called interest. The catastrophic mistake, as you said, is what people use that borrowed future for. They use it to buy the liabilities we just talked about. They finance the vacation, they finance the car, they finance the furniture. They go deeper and deeper into the hole, creating what I call the rat race loop. It works like this. Your paycheck hits your account, but before you see a dime, the money's automatically pulled out to pay Visa, to pay the car loan, to pay the student loan, to pay the mortgage. What's left is a fraction of what you actually earned. You feel deprived and overworked, so what do? You tell yourself, I deserve something nice. And you go out and finance another something nice, tightening the chains just a little bit more. You're working to make everyone else rich, the banks, the car companies, the credit card issuers, at your own expense.
So how does one break that cycle? It feels so overwhelming when you're in it.
It takes discipline, but the rules are deceptively simple. I live by two of them. First, if it does not put money in your pocket, you do not finance it. The only potential exception is your primary home, and even that's debatable. But that means no more financing vacations, no more financing phones, and absolutely, under no circumstances, no more financing a depreciating asset like a car. People say, but I don't have $40,000 for a car. My response is, then you can't afford a $40,000 car. Take the $5,000 you were going to use as a down payment, buy a reliable $5,000 used car with cash, and then take the $700 you would have been paying every month and start buying assets. Start building your kingdom. The second rule is for luxuries. It's called the rule of 5. If you can't afford to buy 5 of them, you can't afford one of them. You have $15,000 saved and you want to buy a $15,000 watch. Most people would say you can afford it. I say you can't. Because if you spend all your money on that watch, you have no soldiers left to go out and build your wealth. But if you have $75,000 in your investment portfolio and you want to buy that same watch, go for it. You've earned it. The purchase is insignificant to your overall financial strength. This rule isn't about deprivation. It's about shifting the goalpost from can I afford the payment to is my financial foundation strong enough to handle this with ease? Debt isn't just borrowing money. It's pre-selling your future freedom at a discount, and most people are trading it for things that will be worthless in 5 years.
That rule of 5 is a massive mindset shift. It's about earning the right to afford luxuries, not just financing the appearance of them. It's powerful. Okay, so let's tie this all together. We're using law number 1 to buy cash-flowing assets. We're using law number 2 to protect our income from the trap of debt. But when we do need to spend money on our business, on our home, on ourselves, how do we make the right choices? This brings us to your third law. Price is what you pay, value is what you get. How do we apply this without just becoming obsessively cheap about everything?
A lesson learned the hard way.
The hardest way.
And this applies everywhere. Should you buy the $20 a month buggy software that crashes all the time and wastes 5 hours of your week? Or invest $100 a month in a professional tool that saves you 10 hours a week? The price-focused person sees an $80 monthly loss. The value-focused person sees a net gain of 15 hours and less frustration, time they can now use to build their business or be with their family. This is especially true when it comes to investing in yourself. People will balk at spending $2,000 on a course that could teach them a skill that earns them an extra $20,000 a year for the next decade. They see the price, not the 100x value. Now, to be clear, this is a journey. When you're just starting out and struggling to pay the bills, you have to be price conscious. That's survival. But the goal is to use law number 1 and law number 2 to build a financial foundation so strong that you can afford to graduate from a life dictated by price to a life guided by value. They all work together as a system. One of the most expensive things you can do in your financial life is to be cheap with your most important investments, your tools, your team, and above all, yourself.
Max, that final law about price versus value is so critical. And your contractor example was the perfect illustration. It makes me wonder. We all have these moments in life where a theoretical lesson becomes painfully real, a moment that's so impactful it's etched into your memory forever. Was there one specific turning point in your own financial journey, a failure or a breakthrough, where that lesson about price versus value truly crystallized for you? A time you paid a heavy price for choosing cheap?
Oh, absolutely. There is one story that I don't often share, but it was probably the single most important and painful business lesson I've ever learned. It goes beyond just a contractor. It was a lesson about people, trust, and the true cost of cutting corners. Early in my career, I was launching my first significant online venture. I had poured all my savings into it. We're talking late nights, sleeping in the office, ramen noodle dinners, the whole cliché. I was bootstrapping everything and every single dollar counted. I needed to hire a key role, someone to manage our digital marketing. This was the engine of the entire business. I interviewed two candidates. One was a seasoned professional, let's call her Jane. Her resume was impeccable, her references were glowing, and she had a clear strategic vision. Her salary request was at the top end of my budget, maybe even slightly over. It felt like a serious investment. The other candidate, Tom, was charismatic, talked a big game, and promised the world for about 60% of Jane's salary. My price-focused, scarcity mindset brain went into overdrive. I thought, this is a no-brainer. I can get the same results and save 40%. I'm a savvy entrepreneur. I convinced myself that Tom's enthusiasm could make up for his lack of a proven track record.
I think everyone listening can feel that internal debate, the voice of logic versus the voice of the budget.
Exactly. And I let the budget win. I hired Tom. The first month was fine. Lots of activity, lots of impressive-sounding reports. But by month 2, I started noticing things. The numbers weren't adding up. Ad campaigns were being run inefficiently, burning through cash with little to no return. When I asked for details, the answers were vague. He was great at looking busy, but terrible at producing results. By month 3, it was a disaster. We had spent a significant portion of our marketing budget with almost nothing to show for it. Worse, our brand's online reputation was taking a hit from poorly executed campaigns. The cheap hire wasn't just failing to produce value, he was actively destroying it. The breakthrough, or rather the gut punch, came when I finally had to let him go, and I called Jane, the first candidate, just on a whim. I was humbled. I explained the situation and asked if she might still be interested in consulting. She was polite, but she said something that has never left me. She said, "Max, I'm now leading a team at another company that saw the value in my strategy. My consulting rate now, to clean up a mess like the one you're describing, is 3 times the salary we originally discussed." And in that moment, it all hit me. I hadn't saved 40%. I had lost 100% of the money I paid Tom. I had lost 3 months of critical time we could never get back. I had damaged my brand, and now the cost to get the right person was exponentially higher. My attempt to be cheap had cost me more than I could have possibly imagined. It was a masterclass in value. I learned that day that when you're dealing with critical functions, be it surgery, legal advice, or the engine of your business, good enough is never good enough. Paying for expertise isn't a cost, it's an insurance policy against catastrophic failure. I tried to save 40% on a key hire. I ended up losing 100% of my investment, 3 months of time, and the opportunity to work with the right person. The lesson was brutal. Paying for expertise isn't a cost, it's an insurance policy against catastrophic failure.
Wow. Thank you for sharing that, Max. That is a lesson that transcends finance and applies to every aspect of life. The cost of cheap is rarely just financial. That story is about a hard lesson from the past. I want to shift our focus now and look forward. The world of work, technology, and investing is changing at a dizzying pace. If you had to bet on one single shift over the next 3 to 5 years that will define financial success for the next generation, what would it be?
If I had to place one bet, it would be on what I call the rise of the individual as a cash-flowing asset. For the entire 20th century, the model was to become a valuable asset for a company. You trade your time and skills for a steady paycheck. That model is eroding. Corporate loyalty is a thing of the past, and AI is automating many of the routine tasks that once defined a stable career. The new model, the one that will create the next wave of wealth, is not about becoming an asset for someone else, but about building yourself into an asset. It's about taking your unique knowledge, your skills, your passions, and your personal brand, and turning them into a diversified portfolio of income streams. Think about it. The software developer who works a 9 to 5, but also has a YouTube channel teaching Python that generates ad revenue. The marketing manager who uses her expertise to do high-ticket freelance consulting on the side. The graphic designer who, instead of just doing client work, creates a suite of digital templates and sells them online, creating a truly passive income stream. This isn't about having a side hustle to make a few extra bucks. This is a fundamental strategic shift. You are the CEO of You Inc. Your 9 to 5 job is like your first, most stable client. It pays the bills and funds your initial investments. But the real, long-term wealth, the true freedom, will be built by the assets you create under your own name. It's the ultimate form of financial diversification because you are no longer dependent on a single employer. You are the source. The tools to do this have never been more accessible. The cost to start a podcast, a newsletter, a YouTube channel, an e-commerce store is practically zero. The barrier is no longer capital. It's courage and consistency. The individuals who understand this and start building their personal asset portfolio today will be the ones who are truly financially sovereign in 5 years' time. The old model was being an asset for a company. The new model is building yourself into an asset. Your job pays the bills, but your personal brand, your skills, and your creations will build your empire.
The individual as a cash-flowing asset. That is such a powerful and empowering framework for the future. Max, this has been nothing short of a masterclass. You've given us a new vocabulary for wealth, a clear set of rules to live by, and a vision for the future. Thank you so much for your time and your incredible generosity with your wisdom today.
It was my absolute pleasure, Sarah. Thanks for having me.
To everyone who tuned in, I hope you're feeling as inspired and ready for action as I am. We covered so much ground, from understanding that cash flow is the queen that truly builds your kingdom, to escaping the trap of debt by refusing to spend tomorrow's income today, and finally, to making strategic choices by focusing on long-term value over short-term price. If you found value in today's conversation, I'd like to ask you to do 3 small things that make a huge difference. 1. Share this episode with one friend, family member, or colleague who you know is working hard but feeling stuck. This conversation could be the catalyst they need. 2. Subscribe to WealthWise on whatever platform you're listening on. It ensures you never miss these weekly breakthroughs, and it's the best way to support the show. And 3. To help you put law number 1 into practice immediately, Max and our team have created a simple but powerful tool. It's our free Asset versus Liability Analysis Worksheet. You can download it right now at the link in our show notes. It will change the way you see everything you own. Thank you again for joining us. And always remember, financial freedom isn't about having more things, it's about having more choices.